Hello everyone. Welcome back to my channel. In today's video, I'm going to be showing you the power of compound interest. How to grow your money exponentially. You won't believe what I discovered when I tried to explore this topic. Let's get started. Understanding how the power of compounding works can help you plan for major life milestones as well as increase the return on your assets and savings. With the help of the snowball effect, which illustrates how a small snowball grows larger as it rolls down a hill, it is possible to better comprehend the power of compounding. The same manner, by adding more interest to the money that was previously earned as interest, the power of compounding also aids in boosting your savings. In other words, the strength of compounding results in what is referred to as exponential growth, when both the rising interest and the balance in your account rise at an exponential rate. What is compounding power? In essence, the power of compounding is the act of adding interest on interest, meaning that the amount of money you invest will result in returns from both the initial capital and the collected earnings from earlier compounding periods. Thus, the force of compounding eventually aids in the gradual growth of your wealth. How does the power of compounding work? Different investment options, including fixed deposits and mutual funds, reinvest your money's returns over time, from capital gains or interest, to help produce additional earnings. The following equation can be used to determine compound interest. Compound interest equals total amount of principal and interest in future, or future value, minus principal amount at present, or present value, equals P, 1 plus I, N, minus P, equals P, 1 plus I, N minus 1, where P equals principal, I equals nominal annual interest rate in percentage terms, N equals number of compounding periods. Consider a $10,000 loan with a 5% interest rate that grows every year. What would the interest rate be? This is what it would be. $10,000, 1 plus 0.05, 3 minus 1, equals $10,000, 1.157625 minus 1, equals $1,576.20. Growth of compound interest over time. After 30 years, $10,000 invested at 5% yearly compounding would be worth over $40,000, with over $30,000 in compound interest. Long-term investment returns can be considerably increased by compound interest. While a $100,000 investment earning 5% basic yearly interest would accrue $50,000 in total interest over 10 years, the identical deposit earning 5% annual compound interest would accrue $62,889.46. The total interest would rise to $64,700.95 if the compounding period were paid monthly over the same 10-year period at 5% compound interest. How long should you invest for the greatest compounding returns? The most thrilling feature of compounding is that your assets generate interest on both the initial investment and any prior interest. In general, the ability of compounding aids in the development of a wide base, which increases past earnings with each cycle. Therefore, as an investor, you must keep in mind that compounding's strength resides in its capacity to reinvest returns on your investment. In other words, before the investing time is over, you shouldn't try to withdraw your earnings. Otherwise, you run the danger of restricting the power of compounding's ability to grow your income. Your financial objectives and investment capacity should be taken into consideration when choosing an investment strategy and time frame. The further you want to go, the sooner you need to start investing so you have time to build up the appropriate quantity of wealth. How can compounding benefits improve your savings? Number 1, make an early start. To maximize the power of compounding, as with many good things in life, you must start your investments early. For instance, if you start investing your money as soon as you start earning, the power of compounding will allow your savings to dramatically expand over time. The longer you hold onto your investments without taking any money out of your returns, the more room you give your money to grow because compounding's power grows exponentially over time. With a longer investing horizon, time is on your side, and there is a higher likelihood that your investments will generate more interest. Number 2, choose shorter compounding intervals for more impact. The rate or interval at which the interest multiplies is another facet of compounding. Compounding frequencies for various investment alternatives in India include daily, monthly, quarterly, biannually, and annually. In general, you can observe a more noticeable change in your returns as you increase the frequency of reinvesting. Since you can benefit from a higher rate of return over a longer period of investment, it is advised to invest in equities if you have a lengthy investment horizon. Number 3, be patient and disciplined. You must first establish your priorities and practice discipline when it comes to your investing if you want to build a strong and successful investment portfolio. In order to maximize your investments, you must try to exploit the power of compounding. No matter how much money you make, you must set aside some time to determine your preferences and goals. By doing this, we will be able to comprehend the advantages of long-term regular investments and how the power of compounding would be put to use. At the same time, you wouldn't be easily persuaded to take premature withdrawals that might endanger the growth potential of your fund. Instead of focusing on immediate profits, you should give your investment plenty of time so that it can develop into large money thanks to power. Number 4, select the right instruments. You might not be as financially astute as an experienced stock investor. You shouldn't, however, believe that the power of compounding is not for you. You could find it challenging to invest primarily in stocks because they belong to a volatile asset class and don't provide any return guarantees. The upside of stock investments, however, is that they have historically outperformed all other investment options and asset classes in terms of long-term inflation-adjusted returns due to the power of compounding. When trading with equity, you can limit your losses by choosing a stop-loss method. Otherwise, you run the risk of losing a substantial chunk of your investment. With the stop-loss method, you can pre-order the selling of a stock at a particular price. To fully take advantage of compounding, you can diversify your investment among a variety of market capitalizations and industry sectors. Number 5, put money into fixed return plans. You might be able to optimize the benefits of compounding by investing in direct equities and equities mutual funds. These investments are, however, also susceptible to fluctuations in the market. If investing in high-risk ventures is not your strong suit, you may want to consider other investment opportunities that provide a more stable, fixed rate of compounding returns. The first type of investment is debt, which enables you to obtain consistent returns through fixed interest-producing assets including corporate bonds, treasury bills, government securities, and commercial paper. Bank fixed deposits, FD, and the Senior Citizen Savings Scheme, SCSS, are two additional long-term investing strategies that let you build wealth through compounding. Compound interest is advantageous to whom? Investors gain from compound interest, although the definition of an investor might vary widely. When banks lend money and reinvest the interest they earn into making more loans, for instance, they profit from compound interest. When depositors receive interest on their bank accounts, bonds, or other investments, compound interest also benefits them. Is compound interest a rich-making machine? Yes. Perhaps the most potent tool for creating money ever devised is compound interest. Compound interest has been used to make money by traders, bankers, and other entrepreneurs for literally thousands of years, according to archives. For instance, clay tablets were employed more than 4,000 years ago in the ancient city of Babylon to teach students the mathematics of compound interest. Give the power of compounding to your savings. Compounding's great advantages allow you to quickly maximize your assets and savings in order to support your long-term financial goals. Making an early start and exercising patience with your assets will suffice to avoid impeding their ability to expand. In order to truly benefit from compounding, you must stay invested for a long time. Many investing alternatives in India, such as fixed income and market-linked securities, offer compounding gains. With investments made under Section 80C, you can also receive substantial tax savings. By doing this, you may simply increase your savings by lowering your tax obligation, ensuring that you stay on course for a lifetime of disciplined long-term gains thanks to the power of compounding. You can choose unit-linked insurance products to receive tax benefits and protect your family from any unforeseen circumstances. Unit-linked insurance plans, ULIPs, can assist you in giving your family protection coverage and giving you the chance to engage in the money market based on your risk tolerance. Overall, you may maximize the potential of compounding on your assets while minimizing risk and considering your time horizon. Well, that's all we have for you today. If you gain knowledge from this video, don't forget to give it a thumbs up and hit the subscribe button for more content like this. Thanks for watching.